Most people in the stock market fail because they don't know what type of investor they are. If you want to learn what type of investor you are, stick around to the end of the video, as that is what we'll be discussing today.
I fight to live, I fight to strive. One day I'll have what I want in life.
Make sure you subscribe to the channel and tap that notification bell to stay up to date with all the videos that I'll be posting. Now, when it comes to investing, there are so many options that people can choose, from the dividend strategy, growth strategy, trading. It can often be daunting to try and find which one will suit you. And depending on your goals, your timeline, age, all of that, that will play an important factor in what strategy would work well for you. So, the main types of investors we'll be talking about in this video are dividend investors and growth investors. Now, there are other types of investors. You could class traders as investors. I personally don't, and I will not be commenting on that as it's not in my circle of competence. I have no knowledge about trading of any kind, so I can't talk to you about it. So before we go any further, I must say I'm not a financial advisor. None of this should be taken as financial advice. And with that out of the way, take that as you will. Now back to the video. So in both growth and dividend, there are subsections that will depend on the individual. For dividend, you could have either high yield portfolios or a lower yield portfolio. The higher the yield, the more risk there is normally. The lower the yield, normally the lower the risk. You can also have a high growth portfolio, going into like meme stocks, hype stocks, and trying to get that ridiculous growth, or you could be more safe. We'll first take a look at the dividend stocks and the dividend strategy, and then we'll look at the growth strategy. Timestamps will be in the description below. You can just skip to which one you want. So when it comes to dividend investing, the whole objective of dividend investing is to get passive income. The passive income is paid out in the form of a dividend. A dividend is given to you as a reward for holding a stock for a certain period of time. Some companies pay it quarterly, some annually. It can vary between companies. The amount paid back to you as a dividend will depend upon the company's dividend yield and the dividend per share. The higher the dividend yield, the more money you will get back for the money you put in, and the lower the dividend yield, the less money you'll get back for what you put in. So when it comes to the dividend strategy, there are two main reasons people get into it. One, they want to retire early, known as the FIRE movement, or they want to get a second source of passive income through the form of dividends. With this in mind, we'll take a look at the positives and the negatives of the dividend strategy and who it might work well for versus who it would work against. So when it comes to the positives of the dividend strategy, there are quite a few. One being, you'll get paid a dividend irregardless of the stock price. So whereas in growth you have to have that stock appreciation to make money, the dividends can be paid out to you irregardless of that stock going down or going up. It's so rewarding and great to just wake up and see that you've been paid dividends from X company, Y company, whatever it might be. This keeps you motivated in the long run and can help individuals keep on that path. Another positive is that you can do what's known as the dividend snowball effect. So this basically consists of, if I took £1 here and then I put it into, let's just say 3M, it's a very good dividend company, so in that goes. So the next time I get paid dividend from that company, I'll get paid out more. So I could get paid out £2, and then I could put that £2 then back into that company, and the next time I get paid out, end up with £3. It's not exactly works like that. Obviously, the dividend yield, dividend per shares will dictate that, but that's basically the principle. So for literally just reinvesting your dividends, that in combination with the compound interest is a ridiculous way of making money in the long term. Another great thing about dividend companies are they are usually companies that are well established, such as Coca-Cola. They have an economic moat, which means they are very hard to beat. These companies are solid. You have Microsoft, they've got a low dividend yield, their company, but they are so large. Apple's the same. They're so large and hard to beat. This makes the stock price stable for you. If you're wanting stability, then this is a great option. This one's not necessarily specific to dividend investing, but investing in general. As long as you beat 2% returns per year, you will be outpacing the inflation. So this will then protect your money from being eaten. Have the money work for you, not against you. Most people assume that if you went into the dividend strategy, you would not be able to get any meaningful growth in your portfolio. However, if you take a look at this chart that compares the dividend kings against the S&P 500, so you can see over a 20-year period that the portfolio one, which is the dividend kings, has outperformed the S&P 500. Now, there's a few reasons for this. The first is that the dividend kings experienced a lower number of years with negative returns. The time span had two major bear markets, had 30 months from 2000 to 2002 and 17 months from 2007 to 2009. These were major bear markets, and the dividend kings only had 2 down years compared to the 4 down years of the S&P 500. The second reason is that the worst year for the dividend kings was only minus 17.62%, while the worst year for the S&P 500 was minus 36.81%. Now, the S&P 500 on its best year could not outperform that. They only achieved on their best year 32.31% returns, and the dividends best year was 27.56% returns. And the third reason is that the dividend kings outperformed the S&P 500 in 12 out of the 20 years that this graph shows. We can also see from this graph that each year it will show which was up and which was down, the dividend kings or the S&P 500. So we can see that the S&P 500 had major downs compared to the portfolio of the dividend kings, which only had 2 down spikes here. So it's not necessarily about who has the highest returns in a year, but who can keep the highest returns and avoid the highest downs. This is a factor commonly overlooked by many people. Now, all this information comes from the dividendearner.com, and I'll leave a link in the description for you to go and read this full page. Okay, so now we looked at the positives of the dividend strategy. Now we'll take a look at some of the negatives. Now, the negatives of the dividend strategy is it does require quite a lot of capital to be able to live off dividends. Unless you have a very high dividend yield, like the dividend bull, most people's portfolio, when they build a dividend portfolio, they'll need around 600k to 800k to be able to live off that dividend. This does seem like quite a high target to get to, but again, with the dividend snowball effect and compounding interest, it does get quite a bit easier the later you go. Just at the start, it will seem really daunting to get to. Now, one of the biggest disadvantages of the dividend strategy, in my opinion, is that companies are not required by law to pay out a dividend. Unless you're talking about REITs, which do have an obligation to pay out a dividend, but most companies that you'll invest in do not have an obligation to pay out a dividend. They can cut it whenever they want, they can suspend it whenever they want, which is a prime example. If you think of Disney, they cut their dividend completely, and then recently AT&T reduced their dividend after merging with another company. Now, if you're younger and have a lot of time, this is not necessarily a problem. They could bring it back, whatnot. But if you're in retirement and needing this as your main income, and they've literally just said, nah, mate, throw it, you've lost a huge chunk of your money there. You can then sell that company and put it into another to get the dividend there, but for that time you will be hurting. So that's just something to bear in mind. Now, this is again a rule for investing in general, not trading. Trading something different. But there's no point getting into investing if you're not committed to the long term and you're not willing to keep adding money in over time, say like once every month. If you keep hopping between strategies, taking your money in and out of things without giving it time to grow, then there'll be no point. You might as well just go to be a swing trader or a day trader. Now, this strategy works well for mostly young people, as they have a lot of time to accumulate that wealth, to grow their portfolio. The sooner you start investing, the better off you'll be, the easier you'll make it for yourself. Older people, they could do the dividend strategy, but they would either need a very aggressive high dividend yield portfolio, or they would need a ton of capital ready to just splash into a dividend portfolio. Now, like I mentioned, the dividend strategy will become extremely powerful later in your life. It will literally just print money for you at a certain point. You can put it into a dividend calculator and you'll see this happen. It's very amazing. If you think Warren Buffett made most of his money in his later years, not his beginning years. Einstein said himself that compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. And that's never been truer. Again, if you want to learn the psychology of money, check out my previous video. Okay, so now we're on to growth stocks. Growth stocks is the ultimate embodiment of risk versus reward. You can have amazing reward. If you think of the Dogecoin millionaire, he put loads of money into Dogecoin. It paid off for him. He became a millionaire, but then he lost £1 million because he didn't sell and Dogecoin dropped. It's the same with the stock market. You have people manipulating different stocks, meme stocks, hype stocks. These are the traps you have to avoid unless you are knowledgeable and willing to put that risk in. Again, risk versus reward. That's all it is. That's all you need to remember. If you're someone who's very risky and is okay with losing money, only invest money you are willing to lose, because that's a very real possibility that might happen to your capital. Now, for me personally, when I started, I was in a mix of dividend and growth stocks. Now, that's something you can do at the start. With my small amount of capital, I was able to play around with both strategies, find which one I sort of gravitated towards more, and then as I just sort of went to the dividend strategy myself. The growth stocks is very fun. That's one positive about growth stocks. They're very fun and addictive to be in. But then again, that can be a negative if you don't know how to control your emotions. So to summarize this topic, I would only suggest people get into individual stocks when they have built that foundation knowledge by watching YouTube videos, reading the investing books, and then they have figured out which kind of where they want to go a little bit. Then you can just put a small amount of capital in, play around with that, see where you'll gravitate towards more, learn the ups and downs of the stock market, how it works with real money. From doing this, you'll then learn how to analyze companies at a high level. You only want to invest in companies you understand, and to do that, you need to be looking at the fundamentals of the company, the income statements, the balance sheet, where the company is predicted to go, what kind of advantages they have over other companies, their business management, their leadership, all of that. If you need ideas, go check out my stock analysis videos. They'll show you basically what you need to do in order to analyze a company and to understand it so you're comfortable investing in it. ETFs are basically your best friend if you just want to put money in there consistently and leave it, not do too much thinking. That'll be your best friend for you. If you want passive income, go down the dividend route. If you want growth, then go down the growth route. But only invest in the individual stocks when you've learnt the knowledge of how to analyze it and how to manage your emotions. Again, go check out the video of managing your emotions. It's called How to Build Wealth Step by Step. Go check that video out. It's a very good one. And then with your little bit of capital you put in, just find out what type of investor you are. See what you gravitate towards, see what you like more. And then from this, you can then build upon that. That'll be your foundation that you can build upon. YouTube will be your best friend in finding out what type of investor you are, learning about the stock market. There's so many videos on the subject. You just need to be careful which ones are trying to like hype a stock up or trying to manipulate you a bit. You just need to be a bit diligent on where you pick your sources from. And then you can go read some investing books, go to webinars, conferences. There'll be some of the best things you can do to gain your knowledge that way. Alright, so thank you for watching this video on different types of stock investors. Hope you got some value out of it. If you did, make sure to like, comment, subscribe, all that good stuff. Check out all the links in the description. There's a Trading 212 link down there. You can go on that, get a free share. You'll be on a waiting list. There's a waiting list in a minute to get a free share. And there's also a practice account on that app you could use to then play around with 50,000 of virtual currency. So that could be something you could do. I started doing that myself. Then there's Revolut card down there, and then all the other links down there as well. Bitcoin, if you want to get in some of that, there's Gemini and Blockfi. Blockfi gives you interest on that crypto. And I'll catch you in a bit. Peace out.
Tell me pretty lies, look me in the face. Tell me that you love me, even if it's fake.